This is The Bottom Line. The Bottom Line on 938 Live.
Now, India's budget is promising comprehensive reforms targeted at boosting long-term growth and cutting the government's budget deficit. Finance Minister Arun Jaitley pledged that India's economy would expand at an annual rate of 7 to 8% within 3 to 4 years. This while meeting a budget deficit target of 4.1% of GDP for the current fiscal year. To open up the economy, the government will also lift caps on foreign investment in defense and insurance sectors. For his analysis, joining us today is PK Basu, Chief Strategist at years.Economics. Good morning, PK.
Good morning.
Now, in the lead up to the budget, PK, there was tremendous pressure for strong economic reforms in a more business-friendly environment. Did it meet these expectations?
No, I don't think the budget met those expectations. It was a pragmatic and workmanlike budget, and it had a few significant positives, including the fact that it makes the environment for REITs much more attractive in India. It also provides for substantial fiscal consolidation over the next 3 years, which is positive and which should have a positive impact on reducing long-term interest rates in India over that time. So there are some positives, but in terms of big bang economic reforms, the budget was a disappointment. It was a workmanlike budget for the rest of the 8.5 months of this fiscal year. There were lots of hints of substantial reforms to come down the road, including the fact that there was a tremendous amount of spending and allocations and incentives for entrepreneurship, for skills development, and for the manufacturing sector. I think those are the three areas that the government is going to focus on, especially in its next budget in February next year.
What about in terms of dealing with the budget deficit? What's your assessment?
Well, they have stuck to a deficit target of 4.1% of GDP. I think it'll be a bit challenging to reach that this year unless growth can accelerate. I think growth is going to accelerate somewhat, and they have a target of just over 5.5% growth. I think the economy is going to do a little bit better than that. The export sector is doing very well now. Manufacturing should begin to revive, and consequently we should get a slightly faster growth pace and consequently stronger revenues. But over the next 2 years, they're looking to reduce the deficit to 3% of GDP, which would be the lowest in India for about 20 years. And that is a very positive development, the fact that they're looking to substantially reduce the fiscal deficit over time.
Let's talk about the GST. The administration is targeting to impose this by December. What impact will this have on the economy and Indian consumers, of course?
It will be hugely positive when introduced because in a large country like India, a GST that covers the whole country will substantially reduce tax administration costs. It will make it much easier for businesses to calculate exactly what they're going to be paying. And the smoothness of introducing something like a GST across the whole country will be significantly positive and should actually provide a boost to GDP of about 1.5% to 2% within a year or two. But the GST is something that has been talked about for a long time. We will basically turn positive about it when it's actually introduced, not when it's merely being talked about.
Now, India's stock index, the Sensex, rose 5% since Prime Minister Narendra Modi came into power in May. Given the pro-growth strategies in this budget, will it continue charging ahead, do you think?
I think the market is likely to consolidate a bit because there isn't that much in the budget to really stimulate a significant acceleration in growth. I think there is enough there to suggest that growth is going to be a bit stronger going forward, but the lack of big bang economic reforms means that the market will struggle a bit to rise substantially from these levels.
Okay, thank you very much for that, PK. PK Basu, Chief Strategist at years.Economics, joining us on The Bottom Line today.